Hello everyone. We are going to do a super quick revision of IND AS 111 joint arrangements. An IND AS which is added along with your consolidation chapter in module number 5. So it's a very easy standard. Maybe it takes hardly 30 minutes. Let's quickly get into this, starting with the meaning of joint arrangements. Joint arrangement is a contractual arrangement. I'm writing only the keywords. Contractual arrangement. Okay. To carry out an economic activity which is subject to joint control. Okay. So joint arrangement is a contractual arrangement between two or more parties. Of course, there should be two or more parties. Then only it can be joint. So contractual arrangement between two or more parties which is subject to joint control. So what is this joint control? JC. That is decisions. There is joint control when decisions about relevant activities. Decisions about relevant activities require unanimous consent. Need not be 50-50 share. Decisions about relevant activities require unanimous consent. So what is unanimous consent? Both parties should agree, irrespective of the shareholding. It need not be 50-50 ratio. If it is 30-70 also, but there is a contractual arrangement, as there is joint control and unanimous consent is required, then it is a joint arrangement. Okay, fine. Now, joint arrangement. What is the accounting of this joint arrangement? To study the accounting of joint arrangement, first you need to know the types of joint arrangement. There are two types of joint arrangement. Come on, what are the two types of joint arrangement? JO and JV. What is this JO? Joint operation, and JV, joint venture. So what is this joint operation? What is joint venture? What is joint operation? What is joint venture? Okay. So there are three criteria to identify whether it is a JO or JV. What are the three criteria? I want you to learn these points. First one, JO need not be it can be, but it is not required. It is not compulsory. JO need not be a separate legal entity. Need not be a separate legal entity. Need not be a separate legal entity. But JV should be a separate legal entity. Okay. So need not be a separate legal entity. Without forming a company, you can do joint operations, but only with a separate legal entity, you can say it is a joint venture. Okay. Then 2. Rights and obligations over assets and liabilities. I'm not clear. Operators, if A and B start AB as a joint operation, A and B will have rights over the assets and liabilities. They have rights over assets and liabilities. Time being, they have rights and obligations over assets and liabilities. If AB is not paying, of course, the liability can go back to A and B. So, rights and obligations over assets and liabilities. Joint operations, assets and liabilities are operators, assets and liabilities. So, rights over assets and liabilities, rights and obligations. So, once more, rights and obligations over assets and liability means if A and B together formed a JOAB, maybe to construct a flyover, maybe to construct some building or to do some operations, if they have a JO, AB's assets and liabilities are A and B's assets and liabilities. There will be a contractual arrangement, whether they have there is a contractual arrangement where it is specifically written 30 is to 70 ratio. Assets and liabilities will be divided in 30 is to 70 ratio. Then assets of AB will be 30% belongs to A and 70% belongs to B. So, rights over each and every asset and liability is a criteria to be considered as joint operation. So, what about joint venture? There is no rights and obligations over assets and liabilities. Rights over net assets, because it is a separate legal entity. Do you think a shareholder is having rights over the assets and liabilities? No, they have rights only on the net assets of the company. After realizing all assets, after settling all liabilities, only the residual interest the shareholders will have. So rights over net assets. What is the last point? Primarily, joint operations primarily aim to provide parties with output. That is, JO does not have economic independence. Okay. JO does not have, generally AO does not have, generally JO does not have economic independence. Whatever output produced by JO is primarily sold to the operators. It will be sold to operators. That does not, JO does not have economic independence to sell it to other party, to a third party. Generally it is to be sold to the operators. Okay, so here there is economic independence. There is economic independence. There is economic independence. Uh, So let's revise quickly. Joint arrangement is a contractual arrangement between two parties to carry out an activity which is subject to joint control. Joint control means unanimous consent. Joint arrangement can be of two types, JO and JV. So generally JV is a separate legal entity and JO is not a separate legal entity. Naturally, the operators have rights over assets and liabilities, but being a separate legal entity, venturers does not have, being a separate legal entity, Venturos does not have rights over single assets or liability over net assets. Here, joint operation does not give economic independence, but here there is economic independence. Let's take this example. AB Limited and CD Limited have entered into a framework agreement to manufacture and distribute a new product X. AB Limited and CD Limited have entered into a framework agreement to manufacture and distribute a new product X. Okay. The two activities to be performed as per framework agreement, that is manufacture of product X. We should manufacture X and distribution of product X. Okay. The manufacturing of the product will not be done through a separate vehicle. Separate vehicle, yeah, separate legal entity. Manufacturing of the product will not be done through a separate vehicle. The parties will purchase the necessary machinery in their joint name. Okay. For the so which means parties have rights over the assets and liabilities. So manufacturing of product X confirmed, it is a JO. For the distribution of the product, the parties have established a new entity. For the distribution, they started a new entity, ABCD. All the goods manufactured will be sold to ABCD Limited. So that manufacturing of product X is a JO, which does not have economic independence. So all the goods manufactured will be sold to ABCD as per the price mutually agreed by parties. Then ABCD Limited will do the marketing and distribution of the product. Both the parties will have joint control over ABCD Limited. The legal form of ABCD Limited causes it to be considered in its own right, which means ABCDs, the assets and liabilities held in ABCD Limited are assets and liabilities of ABCD Limited. That is our typo. ACD Limited, ABC Limited. It's actually, there is no ACD here. There is no ABC here. It is ABC Limited. And not the assets and liabilities of parties, which means ABCD is a joint venture. Further, the contractual arrangement and other relevant facts and circumstances also not indicate otherwise. Determine whether various arrangements under the framework agreement are JO or JV. Example, if you get a question like this for 4 marks, what should I write? First, you should write the meaning of a joint arrangement. There are two types of joint arrangement, JO and JV. Then you should write here the manufacturer of product X is JO, as the assets are acquired in their joint name and it is not a separate vehicle. And then ABCD is a joint venture as it is a separate legal entity. Assets of ABCD Limited are assets of ABCD Limited. Hence, it is a joint venture. Are you clear? Hope so. Then one more example. One more example to understand that economic independence part. If there is a doubt, let's read one question. Two parties structure a joint arrangement in an incorporated entity A. Oh, there is a joint arrangement in an incorporated entity A. Okay. In which each party has 50% of ownership interest. The purpose of the arrangement is to manufacture materials required by parties for their own individual manufacturing process. It's not a JV, it is JO. From the second line, I can understand why. Because the goods manufactured is required by the parties for their own individual manufacturing processes. The arrangement ensures that the parties operate the facility that produces the materials to the quantity and quality specifications of the parties. The legal form of entity A, through which the activities are conducted, initially indicates that the assets and liabilities held in entity A are assets and liabilities of entity A, because it's a separate legal entity. So assets and liabilities of A are assets and liabilities of A. The contractual arrangement between the parties does not specify that the parties have rights to assets and obligations for the liabilities of entity A. Some more facts, relevant facts and circumstances are given. The parties agreed to purchase all the output produced by entity A in a ratio of 50-50. Entity A cannot sell any output to third parties, okay, because the purpose is to provide the output, purpose is to provide the parties with output they require. Okay, the price of the output sold to parties is set by both parties at a level that is designed to cover the cost of production. So, on this basis of this operating model, the arrangement is intended to operate at a break-even level. Based on the fact pattern, determine whether the arrangement is a joint operation or joint venture. So here, what is the answer? It is a J. Oh, it is a joint operation. It is a joint operation because there is no economic independence. To treat it as JV, it should be a separate legal entity, rights over net assets, and also economic independence. So here, economic independence part is failed, so it is a JO. Okay, fine. Now, okay, fine. Now, what is the accounting? Now, what is the accounting of this joint operation or joint venture? What is the accounting? If it is a joint operation, things are very easy. If it is a joint operations, assets, liabilities, revenue, and expense, I can take over to the extent of my share. As per the contractual agreement, if you have 30% rights, take over 30% of assets, 30% of liabilities, 30% of income and expense. So operator should take over operator's share of assets, liabilities and revenue and expense. What if it is joint venture? Venturer should prepare consolidated financial statements. Venturer should prepare consolidated financial statements as per IND AS 28. Okay, not clear. JO, JV, not clear. Okay, now let's see this question number 22 in your study material, which is very easy. Let me quickly read. AB Limited and BC Limited have established a joint arrangement through a separate vehicle PQR. So, separate vehicle. Is it separate legal entity? The legal form of separate vehicle does not confer separation between the parties and separate vehicle itself, which means the party and the separate vehicle is not separate. So then why do you call it as a separate vehicle? Does not confer separation between parties and separate vehicle. So it's not a separate legal entity. Thus, both the parties have rights to the assets and obligations for the liabilities. So there is rights and obligations over assets and liabilities of joint operation. So this is a joint operation and not a joint venture. Okay. Both parties own 50% each of the equities interest in PQR. However, the contractual terms of the joint arrangement state that AB Limited has rights to all the building number 1. So, all the building number 1 belongs to AB Limited, and obligation to pay all the debt owned by PQR to lender XYZ. So, this is also belonging to AB Limited. AB Limited and BC Limited have rights to all other assets of PQR and obligations for all other liabilities in proportion to their equity interest 50%. So all the other assets and liabilities will be shared in 50-50. Debt 240 we already said. Employee benefit obligation share of AB Limited is 50. Equity interest, ownership right interest, that is also 70, half. Cash 20, building number 1 240, building number 200. So that's it. How should AB Limited record its financial statements, its rights and obligation? To the operator's balance sheet, operator should add this. Okay. So that will be considered in the operator's balance sheet. Are you understanding? So asset side, you add this, and to liabilities you add this. Since AB Limited has rights to all building number 1, it records the amount in its entirety and also debt owned by PQR to XYZ. Okay, that's it. Okay, so here accounting part is very easy. Account the operator's share of assets, share of liabilities, share of net profits. That's it. And JV, joint venture entity, then don't take just your share. You should have separate financial statements and consolidated financial statements. So go to IND AS 28 to get the guidance on how to prepare consolidated financial statements. So is the standard finished? No, one more small area is there. So there is one more area, that is, how should an operator recognizes sales or contributions to JO? First, I'm going to read this question and we'll learn from this question. Okay. A Limited is one of the parties to a JO, holding 60% interest in JO. And the balance 40% interest is held by another operator. A Limited has contributed an asset held by it to JO for the activities to be conducted. The carrying value of the asset sold is 100. Asset was actually sold for 80 at a loss of 20. No, I didn't understand. Okay. A and B. There are two parties to a JO. Joint operation. A and B together, they are doing some operations. So A's share is 60% and B's share is 40%. Okay, A's share is 60% and B's share is 40%. Understood. Now A has sold some goods to, not goods, A has sold an asset to JO. In the books of A, the asset was appearing at 100 and sold to JO at rupees 80. So how this should be accounted in the books of A? So A transferred, A sold, or A contributed an asset worth 100 rupees at rupees 80 to JO. How A should account this? So what is the rule as per IND AS 111? The transactions between the operators and joint operation should be recognized only to the, I want you to learn this line, only to the extent of other parties' interest. Only to the extent of other parties' interest. Not clear. Only to the extent of other parties' interest. Only to the extent of other parties' interest in joint operation. Means not clear. Explain this to me. Okay, fine. Now A sold 100 rupees assets to JO. If JO is having an asset, 60% will come back to the books of A. Yes or no? An asset of JO, 60% of assets of JO is for A. So 100 rupees if I sell, 60 will anyway come back to my books. Yes or no? If I sell something, a 60 percentage will definitely come back to my books. Then why should I record that as sale? You should record sale only to the extent of other parties' interest, means you should record sales only to the extent of, you should recognize gains or losses only to the extent of that 40. Otherwise, it's like I sold to me and earned a profit. Not correct. I sold to me to the extent of 60% and incurred a loss. Not correct. So, record only to the extent of other parties' interest. Which means what should be the journal entry here? Journal entry should be bank account debit. How much bank account debit? You got 80, right? 80 into 40%. Okay, 32. 2. Asset. Asset is to be de-recognized not at 100. 100 into 40%, 40. And there is a loss on sale, 8. P and L loss on sale, 8. Seriously? Yes. So the total loss on the transaction is 20. A Limited shall record loss on sale of asset to the extent of 8. Other parties' interest. Loss of 12 shall not be recognized. It's like an unrealized loss. Have you understood this? Okay, I hope it is okay. It is easy. Now just ulta. That is A and B are two parties. Same example of AB, which is a JO. Now A purchased from AB. The same example, same thing. A purchased from AB. A had 60% share. B had 40% share. Now A purchased from AB. An asset of rupees 100 rupees you acquired at 80. So what should be the accounting treatment? If AB had an asset of 100, already 60% is appearing in the books of A. So already I have 60%, then how can I purchase again? I already have an asset, then how can I purchase it again? So you are purchasing only to the extent of other parties' interest. So the journal entry should be asset account debit to bank. How much? You bought an asset for 80 means 80 into 40 percentage. Are you understanding? 80 into 40 percentage. So what is given? A Limited should not record its share of loss until the asset is resold to a third party. The joint operation has sold an asset of 80 by incurring a loss of 20. Hence, A Limited shall record the asset at 92. Why 92? Of that 100, already 60% was mine, 60. And now I acquired 32 worth of asset. So now the value of asset is 92. Okay. So 80 and my share of loss I have is included in the value of asset. Further, the accounting its interest in joint, while like A Limited shall not record any share of loss incurred in sale of transaction by joint operation. This should be the journal entry. I think this is very basic and it is clear. So that takes care of our entire joint arrangements in days. So joint arrangement is like if it is JO, I'll give the accounting. If it is JV, go to IND AS 28. So if it is JV, go to IND AS 28 and prepare consolidated balance sheet, consolidated financials. So if it is JO, account the operator's share. Take over my share. That's it. So, what is the accounting of JV? Go to IND AS 28 and do the consolidated financials. Venturer should prepare the consolidated financials. So, how to prepare consolidated financial statements in case of joint venture arrangement? Let's discuss this in the next video. Thank you for watching. Take care.